fear, inflation, war, failing banks, and stock market collapse. Uncertainty shakes the markets. What would be next? How to invest in 2023. Investing in 2023 is similar to investing in any other year, but it's important to keep in mind that market conditions and trends may change. However, here are some general principles that can guide your investment decisions. Set clear investment goals. Define your financial objectives, such as saving for retirement, buying a house, or funding your children's education. This will help you determine the appropriate investment strategy and time horizon. Diversifying your portfolio is an important option that many investors use. You can allocate your investments across different asset classes, such as stocks, bonds, real estate, and commodities. Diversification helps reduce risk by spreading your investments across multiple sectors and regions. Research and stay informed. Be mindful of potential economic factors, like recessions. Causes of recessions. Recessions can be triggered by various factors, including tightening monetary policy. Central banks raising interest rates to control inflation can slow down borrowing and spending, potentially leading to a recession. Financial crises could also be a reason for economic slowdown. Events like banking failures or stock market crashes can undermine confidence, disrupt the financial system, and trigger recessions. Events such as oil price spikes, natural disasters, or geopolitical tensions can adversely impact economies and lead to recessions. Recessions can have wide-ranging effects on individuals, businesses, and governments, including unemployment. Unemployment recessions often result in a rise in unemployment as businesses cut jobs to reduce costs. Reduced consumer spending. With job losses and reduced income, consumers tend to spend less, leading to decreased demand for goods and services. During recessions, businesses may postpone or scale back investment in new projects, which can further dampen economic activity. Recessions can lead to a drop in the value of assets such as stocks, real estate, and commodities. It's important to note that recessions are a normal part of the economic cycle, and economies often recover and expand after a period of contraction. During a recession, it's wise to carefully manage personal finances, maintain an emergency fund, and consider adjusting investment strategies to align with the economic conditions. Reading the business and economic news on a daily basis could be very helpful to keep track on your investments. Stay updated on current market trends, economic indicators, and industry news. Conduct thorough research before making investment decisions, and consider seeking professional advice if needed. Understanding your risk tolerance is crucial when investing in stock market. A lot of people got taken by emotions. They lose big portions of their positions, if not all, simply because of anger. Remember, on the stock market, patient people make money of impatient people. You can also take additional steps by assessing how much risk you are willing to take with your investments. Generally, higher risk investments like stocks have the potential for higher returns but also carry more volatility. Lower risk investments like bonds provide more stability but may offer lower returns. Focus on the long-term perspective. While short-term market fluctuations are normal, focus on the long-term growth potential of your investments. Avoid making impulsive decisions based on short-term market movements. Consider index funds or ETFs. These investment vehicles offer diversification by tracking a specific market index. They can be a cost-effective way to gain exposure to a broad range of assets. Keep an eye on emerging industries and technologies. Consider investing in sectors that show promise for future growth, such as renewable energy, artificial intelligence, or healthcare technology. However, always perform due diligence before investing in any specific industry or company. Evaluate company fundamentals. If you invest in individual stocks, analyze a company's financial health, competitive advantage, management team, and growth prospects. Fundamental analysis can help you make informed investment decisions. Regularly review and rebalance your portfolio. Periodically reassess your investments to ensure they align with your goals. Rebalance your portfolio by selling overperforming assets and reinvesting in underperforming ones to maintain your desired asset allocation. Consider tax implications. Be aware of the tax consequences of your investments. Consult with a tax advisor to understand the tax implications of different investment strategies and to optimize your tax efficiency. Remember that investing involves risks, and past performance is not indicative of future results. It's essential to conduct thorough research and consider your own financial circumstances before making any investment decisions. Thanks for watching.